global financial conditions are going from bad to worse. And I mean much worse.
This story is about to get much, much worse.
This is going to have a massive impact on the housing market and the stock market. So in other words, it's going to affect everyone. I'm Biko Konstantinos, and that's what we're going to talk about today. Make sure you give this video a like, and if you want to hear my commentary and analysis on the world markets, subscribe to my channel. Together, we can increase our knowledge and understanding of what's going on. Now let's see why the global financial markets might be headed for disaster. Soaring inflation is gripping nearly every country. Prices of fuel, gas, and electricity are rising exponentially, and prices of food and many other goods and services are going through the roof. Current inflation levels in many countries are the highest they've been in 30 or 40 years. And this is having a very large impact on the population, especially the low income earners and the most vulnerable. Producer price index changes are showing extremely high increases for the prices received from producers for everyday goods and services. So Turkey saw a PPI increase of 115% year on year, Ireland 106%, and then we've got many countries in the Eurozone which have also been affected by high PPI increases. And a lot of this is due to the increased price for oil, gas, wheat, etc. Now countries can't afford runaway inflation or hyperinflation because that can destroy the economy. So what they'll do, and what they've already started doing, is to raise interest rates. Now interest rates have been on a decline for many years now, and during COVID were reduced to almost zero. Now many people would argue that ultra low interest rates created a bubble in the stock market and in the housing market. Now we won't know until in hindsight whether these were a bubble, but it definitely played a big part in my opinion. And the other thing was the threat of high inflation was discounted by the Fed, who originally called it transitory, and I think many people assumed we were going to have an ultra low interest rate for a lengthy period of time, and this created an extra strong demand for assets such as housing and stocks. Companies were able to pay next to nothing on all their borrowing, which made it easier for them to make a profit as their margins were bigger. But now with the threat of inflation, we've had a massive pivot from the Fed and other central banks. So where last year they were very dovish, now they've turned extremely hawkish and aggressive because they're freaking out that runaway inflation will get out of control. So interest rates are definitely on the way up, and this is going to cause major pain for people, for businesses and companies, and also for the economy. We've got a major housing affordability crisis. Now before COVID, housing was very expensive in many countries, especially compared to the average income. However now, after a boom that's seen 30 to 40% house price rises in the last 2 years, housing affordability is at crisis levels. We have a major wealth gap where property owners have seen their net worth rise exponentially with this housing boom, but non-property owners have basically missed out altogether on any rises. So the distribution of wealth is now massively skewed between those two groups. What's even worse is that high inflation and very low vacancy rates has created a rental crisis with extreme demand for rental properties, rent prices soaring. So we're seeing some people being kicked out or not being able to get a rental and becoming homeless, which is an absolute tragedy. The stock market boom looks to have ended. So we had a supersized rally or boom period in the stock market since COVID, but that looks to have ended now as we've seen topping patterns for many of the global indexes. Now the stock market could continue to go up, but both the fundamentals and the technicals are looking bearish in my opinion. Take the Russell 2000 Small Caps Index for example. This was the first index to really show that all was not so well in the post-COVID rally. So ever since March 21, we had a sideways topping pattern, which has recently broken down and is looking very bearish. The Russell needs to only fall about 200 more points and it'll be at the pre-COVID level of around 1700. So I get the feeling that the stock markets keep trying to rally. People talk about buying the dips, or people see some big companies fall and they think, should I buy now? That sort of thing. But if this is actually a bear market, then rallies get sold off and the price ends up getting pushed lower. At this stage, I don't believe we've seen any real fear or panic in the stock market, but if prices break down, then we could see some real fear enter the market. And that's when you see panic selling. Now, because there's so much money tied up in the stock market, large declines will impact many people. And that will then flow onto the economy as people who've lost money tend not to spend as much. Now, as well as potential declines in the stock market, there's going to be a lot of downward pressure on the housing market as well. Because of the ultra low interest rates combined with specific COVID related factors, we've seen an unprecedented boom and speculation in housing. This has been evidenced by crazy demand on houses and houses selling for way above the asking price. However, now with interest rates being hiked aggressively, I believe that's going to kill all the excess speculation in the housing market, because people purchasing a property won't be able to borrow as much from the bank, because investors will be a lot more fearful because the market has now changed, and because some property owners who are over leveraged might struggle with the repayments. So it might not happen straight away because data for housing tends to be a bit backward looking, and it's not like the stock market where you see daily prices. However, in time, interest rate hikes will have a very big effect on house prices, in my opinion. It just depends how high those interest rates are risen as to how much house prices will fall. Now, as well as interest rate hikes, many countries are now putting in policies to try to improve housing affordability or to reduce overall demand. New Zealand has gotten rid of negative gearing and banned foreign ownership of property. Canada has banned foreign ownership for a period of time and increased the tax payable on empty properties. There's also many other countries that are putting in policies to try to improve housing affordability and housing availability for their population. Now, I believe these sort of policy changes is going to ramp up because countries can't afford to have people be homeless, because that will destroy their entire society. So some of these policies could also have a downward pressure on house prices across many countries. Now, we've got geopolitical risks also occurring with the Russia and Ukraine war. This has seen unprecedented sanctions against Russia, but also retaliatory moves that Russia has put in place, like requiring payment for gas in Russian rubles and things like that. Whatever the outcome of this war is, it's going to have a very big economic impact. It's having a very big contribution to price rises, which is adding to the already super hot inflation across the globe. Another impact could be a food shortage, as Ukraine is the biggest exporters of wheat in the world. So for some countries, this could end up being a humanitarian crisis. And I've recently witnessed in Sri Lanka what a shortage of food can mean to the local people and the desperation it can cause. On top of all that, China is now going through a COVID lockdown where they're practically locking down the entire country. This lockdown is impacting about 165 million people and will definitely have a global economic impact. So how did we get into this position of so many disastrous type impacts occurring at possibly the same time? Well, when COVID first hit, countries went into severe panic mode and went into completely ultra loose monetary policy, which meant huge amount of money printing to keep the economy afloat and reducing interest rates to practically zero. It also meant many stimulus programs and support programs to those people and businesses affected. But what seems to have happened is that we've overstimulated everything. We've created bubbles in the stock market and the real estate market, and national debts have risen exponentially. On top of that, all this money printing has put a rocket under inflation, as we can see what's happening now across the globe. Supply chain disruptions, along with the Russia-Ukraine war, is just taking that inflation up into overdrive. Now, not trying to be alarmist, but with all that going on, we could be headed for economic disaster. And sure, we can keep printing money and prevent that disaster happening straight away, but it's just going to push that problem down the road. There's consequences for every action, and globally, we've employed an ultra loose monetary policy, and now we're starting to see the consequences of that with soaring inflation, and now the requirement to hike interest rates aggressively to curb that inflation. So how do you see this playing out? Do you think we're going to see some big declines in the stock market or the real estate market? Or do you think we might just have a temporary dip before future growth and future price rises? I'd love to hear your thoughts in the comments below. Hey, since you've made it this far, why don't you subscribe to my channel? I'd really love to have you on board so we can communicate, learn, and keep on top of the market. I'm Biko Konstantinos, and I'll catch you in my next video.